Hello, everyone, and welcome to our quarterly market update. The title for this specific market update is AI, which is of course, artificial intelligence, and government deficits, and both of those issues are certainly rather concerning, depending on how you want to look at it. But of course, we'll be discussing many other items in our webinar today. Next slide, please. Again, for those of you who ever participated in any investment-related webinars, we always have to give you this disclaimer. Anything that we're about to discuss today should not be considered investment advice. The information provided during this webinar is entirely for educational and informational purposes only. And we strongly recommend that you either do your own due diligence or reach out to your financial advisor if you decide to implement any of the ideas or strategies that we're about to discuss today. Next slide, please. So usually what I do, of course, when I prepare for our webinars, I look at the people who register for them. And it's interesting this time, we actually have quite a large number. But I would say for the first time, more than half of people who registered are actually not necessarily our clients, not someone in our direct network, which is great. Of course, welcome. And for those of you who haven't met me yet, my name is Alex Seleznev. I'm a certified financial planner and chartered financial analyst. I'm the founder and president of Capital Squared Financial, and we'll talk about the firm in just a moment. But I really want to introduce Asi De Silva, my business partner, again, to those who perhaps haven't met him yet. So Asi has over 25 years of experience investing for hedge funds and institutional money managers. He began his career during the Asian financial crisis of the late 90s and managed a hedge fund portfolio through the global financial crisis. And for those of you who remember that, which I'm sure there are many people that still remember, which is likely a good thing, well, that certainly was not pretty. Asi uses his macroeconomic and market expertise to help clients plan and implement comprehensive retirement planning strategies. And that is where we really collaborate. That was actually one of the reasons why our firms are merged in earlier this year. And Asi is also a chartered financial analyst. And I'll tell you on the personal side, he's also a great person to work with. So in terms of our firm, again, for those of you who are less familiar, Capital Squared Financial, we're really a firm that specializes in retirement planning. We do work with different types of clients, but retirement planning is our specialty. So specifically, we work with people who are thinking about transitioning or already in retirement. And one of the questions I tend to get, well, why specialize in this? What triggered that essentially? And there are multiple ways to address this question, but perhaps the most important one, when someone is, let's say, accumulating funds, when you compare that to someone, perhaps a family that is, ready to retire, their situation tends to be much more complex, specifically on the tax side. That would be a perfect example of that. When someone begins to draw from his or her portfolio, well, the first question is exactly how would you do that? What is the best way to do that so that you keep as much as possible actually in your pocket without paying too much to the IRS? That's perhaps one of the top questions. From what account are you going to draw? With questions such as Social Security planning, and specifically when we work with married couples, exactly how would you structure that? And of course, the most important idea, which is perhaps the primary focus of what we do on the investment side, is to ensure that our clients, enjoy their golden years and do not run out of money over the next, 20 to 30 years. We're a fee-only firm. We always serve as a fiduciary when we work with our clients. And, to say it simply, any advice or any recommendations that we provide, they must be in your best interest. We're very responsive. We respond to most of the questions from our clients within 24 hours, and they very much appreciate it. And again, that's part of our boutique style firm. Since we launched the firm last year, we've been growing rather rapidly. As of today, we manage over $100 million to almost 60 at this point, almost 60 individuals, families, and trusts. And again, that's part of the boutique style approach. Of course, if you want to learn more, feel free to reach out to us or myself or visit our website. Next slide, please. So again, for those of you who ever participated in our market update webinars, we usually try to start with something that kind of describes, the markets over the past 3 to 6 months. So this term all-time high, right? And perhaps many of you heard it. That usually they refer to any particular index, such as the S&P 500 index, when it hits this new, milestone. So as of last Monday, at least, we heard this particular term 34 times this year. So on one hand, of course, this is something that we are happy about. Most of our clients experienced significant growth in their accounts. But on the other hand, that certainly creates a certain level of concern, because even though as perhaps some of stock markets, they don't necessarily die of old age, but at the same time, the higher it goes, the more rapidly potential correction may happen. And of course, we'll focus on all that today. Next slide, please. So yeah, before we again dive into different opportunities and issues, just to again update everyone on the markets as of this year. So in terms of the year-to-date performance, domestic large cap stocks, as measured by the S&P 500 index, are up by 19%, which is rather healthy, to say the least. We're getting closer and closer to the performance we experienced last year. Now, more growth-oriented index, or the NASDAQ index specifically, is up by 23%. And Asi will really unpack it for you in just a moment. But if you look at that performance, it's really attributable to a handful, maybe more than that, basically a good dozen of different stocks. It wasn't necessarily a broad-based rally. Now, small cap stocks, it's interesting. When we were first working on this webinar, they were essentially flat. Now, over the past week or so, 5 to 7 days, we've been experiencing so-called rotation. And again, Asi will talk about that more. And small cap stocks, they're actually up by 7 to 8%, if I'm not mistaken, again, over the past week or so. So it's interesting what's been happening. Developed and emerging markets are in the positive as a category, even though for us as a firm, we've been somewhat neutral on those markets for a variety of different reasons. And then finally, if you look at the overall bond market as measured by the Barclays Aggregate Bond Index, it's actually in the negative as of earlier this week. With bonds, though, I'll just make this comment. Sometimes people just think of them as one category, but there are a lot of different types, just like with stocks. So for those of you, and I would say most of our clients really, that focused on short-term bonds, specifically treasuries, the returns have been in the positive, because that's really where most of them came from. In terms of the 10-year treasury yield, which is sometimes referred to as the market's interest rate, well, the yields have been actually declining over the past couple of days, but they're up since the beginning of the year at 4.2%. And this is, by the way, different from the Fed rate. Again, Asi will talk about that more, but at this point, we are expecting interest rates to begin to decline soon. And then finally, in terms of the sector performance, perhaps not surprising to pretty much anyone who's been following the markets, I would say to any degree, well, technology and communication services stocks, which are really very similar, if you look at the stocks in those categories, they're really leading the way. Technology stocks are up by almost 34%. Now, that was as of earlier this week. Again, certainly not as of today. We've been experiencing rotation as of this morning, and communication services stocks are up by 27. No sectors were in the negative as of Monday. The worst performing is real estate, but still in the positive by essentially 0.25%. So in terms of the questions that we've been, again, getting from our clients, perhaps the most important one, will this rally continue? And again, we've been experiencing this market rally for the past almost 20, not 21 months actually, without a single correction, when the markets are down by 10% or so. So if it continues, would it be the same or would it be different? So Asi, it's all you now, please.
Thanks, Alex. Hi, everyone. I'm glad to be presenting here. I see a bunch of friends from my network. Alex, your intro to the firm was, that for first timers, hopefully useful. I'm going to drill down about 20 slides. I'm going to drill down into some of the material that Alex has laid up here. So the first slide is, this moving, is just a more detailed look at the US stock universe. And, no surprise what Alex just said, large cap growth, that's the category in this corner, is the dominant outperformer. This is where all the tech stocks, the mega cap tech stocks lie. That, as you can see, up to June this year, up 14.8%, notably better than small caps, and also better than the value category, which is a lower, lower growth area. This also a trend that we've seen, not just, this year and the years past, but for the last 5 years, 13.35% for large cap growth. And, just the large cap category has really dominated compared to the smaller cap. And, kind of makes sense when the interest rates went from 0, this is the Fed funds rate, up to 5.25 today. The debt for the smaller companies, a significant amount is floating rate. Whereas for the large companies, they have access to the bond markets and they have fixed rate debt. And so they've not really been impacted by the higher rates, whereas the smaller cap companies, just at least on an interest rate basis, have been impacted negatively. A quick look at the domestic bond market. And here, Alex mentioned it's not one, amorphous blob. It's lots of different areas of the bond market. What I would, we've highlighted in those gray circles, some of the areas that stand out, the shorter term treasury bonds, the government bonds right at the top line. And then if you're a tax paying or, taxable account, the muni bond yields, the tax adjusted muni bond yields, are particularly attractive, especially if you're going kind of what's called the intermediate term, 3 to 5 years. Those are pretty attractive. For those who are not finance geeks like us, if you hear the term inverted yield curve, here's a good example of it. I'm just turning over to my other screen because I can move my cursor and show you. It's this, where the three-month yield today is 5.37%, but then the 10-year yield is substantially lower at 4.2. That's the inverted. A normal yield curve is upward sloping, so the 3-month, if it's 5.37, the 10-year would be higher than that, usually 1 to 1.5% high. So this is this whole inverted yield curve. It has historically had 100% hit rate in predicting recessions, but this time, thus far, it has failed. So it's something that we keep in mind as we think about client portfolios. Let's just look at some of the economic conditions. What's clear is there is a definite slowing, but that's a good thing because the economy was running too hard, or the economic activity was too high. Inflation in the first quarter was going up. The Fed, there was even talk of the Fed having to raise rates. What we've seen is a gradual slowdown. June unemployment, for example, was 4.1%. In January, it was a very low 3.7%. Anything below 4% is considered very low unemployment. And the Fed's own recent quote from the Fed chair was that demand and supply are now in balance. And so the risk of further rate hikes has really gone away quite sharply. And that's part of the reason you're seeing this fairly strong reaction, perhaps rotation into the stock market, because if we do go into a soft landing, then there is less reason to be huddled up in a handful of tech stocks. You can buy some of the more attractively valued larger cap companies, and we'll show you some of that data. There are pockets of uncertainty, and this is not new, right? This has been, commercial real estate, particularly office, credit card delinquencies. These have been getting worse, have been worse, or at kind of warning levels for a good, three, in case of office, for over 12 months. So it's something to watch out, but it's not something new. GDP growth, I'm not going to go over each of them, but they're fine. They've been revised up in the case of the US full year GDP to 2.7%. And I use core inflation because that's what the Federal Reserve looks at. That has come off from 3.9% January to 3.4 in the latest report in May. Excuse me. So what does that mean for the market? To us, the markets are clearly at a crossroads because economic activity is slowing, unemployment cools. That's because the start of it looks like a soft landing today, but a hard landing or a recession always starts as a soft landing, and it's just a matter of whether things even out and flatten out here, or if trends continue to go down and perhaps even accelerate. And it's not clear at the moment. One of the things we should keep in mind is that there is $6 trillion in money market funds, and so these, given the right signals, move quite rapidly into the bond market. And bonds can be, they've not been a good source of total returns this year or the last year or a year and a half, but they could be that. The high deficit is something that is going to be here with us, and that at the margin will put pressure on rates, rates to go up because the government has to raise, we're running about a $2 trillion deficit. And in the second half, the base effect for inflation is going to be more challenging, so that the declines we've seen over the last few months may be more challenged in terms of maintaining. So we might see inflation flatten out, possibly even tick up. So something to keep in mind. I get asked, hey, what about, where are rates going? But we cut a lot. If we see rapid rate cuts by the Federal Reserve, there's a high probability that means they see a very fast cooling or a recessionary outlook. And so you want to be careful about seeking, a sharp decline in federal funds rates or the Fed cutting rates, because that probably means a outlook that is not good for stocks. It will certainly be, if that's the scenario, it will be very good for longer term and intermediate term bonds. So the key message would be that it's somewhat uncertain. The next 6 months are fairly, crucial in terms of giving us more clarity in which direction we're going. And the message would be, there's lots of gains that we have all enjoyed, to be prepared. And, we'll talk about some of the measures we recommend towards the end of the slide deck. Quick couple of, the next few slides are going to look at the breakdown of the performance for this first half. This is to the end of June. No surprise, everyone's heard about, the performance of the mega cap tech. This just shows you how much the, Magnificent Seven had performed. And a good example is, the S&P's was up over 15% to the half. It's up even more now. But the equal weight is the S&P. So all 500 stocks weighted equally was only up 5.1%. And small caps to the end of June was only up 1.7%. So it's quite a bifurcated market where it's being dominated by, just a handful of stocks. Within that, everybody knows about NVIDIA. Some of the stats I find interesting is it contributed nearly a third of the performance of the S&P 500 came from a single stock. The other 499 gave you the other 70%. If you take the top 10 out, you would find that that accounted for well north of 50% of the returns. This kind of narrow performance has generally not lasted, or for an extended period. Just the slide that I'm going to throw out there, as this title says, NVIDIA's performance since 2020 makes Bitcoin blush, because it's just left almost everything in the dust in terms of performance of 1,000+%. And this blue line, if you ask, hey, what's that? It's RCA Corp from 1929. And so I'm just going to leave it there, but just goes to show you how exceptional and extraordinary this performance has been. The good news is that the average stock is not expensive. And slightly busy chart from this is the gentleman who's the head of macro research at Fidelity. Focus is on the blue line, where this is a PE chart, so price to earnings, meaning how much you're paying for each dollar of earnings for the stock market. It's at 17.7, which is slightly above the long-term trend, and that is totally fine given how robust the U.S. growth is, particularly relative to the rest of the world. What makes the S&P expensive are those large tech companies. So the S&P the blue line is the equal weight. So all 500 companies weighted equally. The S&P itself is at a more challenging 24, almost 25 times earnings, which is rather elevated. You haven't seen that except in this 2021 boom. I've used this chart before. Over the very long term, these mega caps, and the chart here is comparing the 10 largest to the bottom 490, or the other 490, you have seen substantial outperformance from that 490 versus the 10. Caveat that though is, there have been periods of substantial, outperformance by the large 10. And, this is one such period where since 2013, we've had a pretty substantial outperformance, which is, well, I'm not sure if it's ongoing. It was ongoing up until last Tuesday, and you've seen a pretty substantial reversal. We've had these reversals before. The question is, they have not sustained, and it's, a week's outperformance by the 490 does not mean that the trend is clear. This pretty great performance has come despite not having lots of money go into stock mutual funds and stock ETFs. So the chart here, it's the purple area. You've seen very modest inflows, and this, for market practitioners, are really scratching their head. I'd put myself in that. How come indices have gone up so much, even though there's not been a huge amount of money going into stock funds in aggregate? And it could be, some of the theories are, because it's this concentration. The top 10 stocks account for about 36% of the weight of the S&P 500. That's close to an all-time high. More and more money is going through passive ETF and index strategies. And ultimately, it feels like a dollar going into the market today has a much greater price impact. And we should keep in mind, if the flows turn the other way, this effect will be, I guess, we'll see the deleterious effects of this same impact, where a dollar has much higher impact on stock prices on the index level than we've had in the past. Just a couple of things. We talked about the economy broadly slowing. This is just a chart of some of the jobs data. This is, if you hear about the JOLTS data, which is a job opening survey that's run. And so you've seen these, it's cooling, but again, it's cooled from a very elevated level to an area that is, looks robust. It's comfortable. So, this is needed cooling, what we need to see for a soft landing. But the question is, where do we go from here? And, that's going to be a tough one. The Federal Reserve has over 300 economists, and they've gotten inflation wrong for about, better part of 3 years now. So I think we're all trying to figure this out. One of the areas that I look at is consumption. Consumption in the US is, nearly 70% of GDP. And if consumption stays strong, you should have, robust economic activity. And, airline travel, this is a chart of the travelers going through the TSA security checkpoints. Maybe this is less discretionary after COVID. We're all kind of spending more on travel. And so it's even better in that regard. But there is no sign, judging by how travel throughput through TSA is tracking in 2024, that a sharp slowdown is imminent. So it's, one thing that we basically pay attention to, trying to give us a lead into what might be coming down over the next couple of quarters. Two last ones. The second to last point I'm going to make is, stock bond correlation. What this chart shows is over the last 20-25 years, since about 2000, when interest rates, particularly after interest rates went down into the global financial crisis, you've had a negative correlation, meaning when stocks fell, your bond portfolio went up. And that's been a very good diversifying effect that kept you've heard about the 60-40 or 70-30 portfolio of 60% stocks, 40% bonds. And that has really led to a really good performance because the volatility of the portfolio was less. What we have seen since this recent rate increase is that you've seen the sharp increase that stock bond correlation now is rather positive. So bonds offer great yields and income, especially if you're retired, but it may not offer the same diversifying benefits going forward. This obviously depends on if, it's quite possible we go back to the prior rate environment, the Federal Reserve cuts rates, we get back to, say 2% interest rates. That seems unlikely. No one is pricing, or the markets are not pricing that. But this looks at, hey, what if it stays elevated? And what could we do to improve the diversification of retirement portfolios, investment portfolios? So if you look at, it's a very short, from an investing perspective, a very short period, 20 to 24, busy chart. We will email this slide deck to everybody, but I've written the kind of the conclusions on the right side, and that's, hedge funds, commodities, trend following strategies, which is also kind of a alternative strategy. Gold and even Bitcoin has provided this diversification impact. And the chart here is the annualized returns is the y-axis, and the x-axis is the annualized volatility. So, you want to have kind of lower volatility to pair with your stock portfolio. One quick chart I want to just talk, since this is not going to be a comprehensive look at Bitcoin. Bitcoin has incredibly high volatility, but if you look at the return profile, it's being the best performing asset over 3 years, and then having bad performance for a year. It's been okay. It's actually historically done well for your portfolio. So I'm just gonna, since I mentioned Bitcoin, leave it there. Perhaps one of our future presentations will go more into the benefits or where the value for this asset comes from.